Hello, everybody, and welcome to Options Discovery on John Lothian News' The Spread. My name is Alex Tang, and just like you, I am no expert in the world of options. But with the help from some, we can learn more about options together. In this week's episode, we're going to be introducing the concept of the options Greeks. We're also going to sit down with the VP of Execution Technology at CQG, Kevin Darby, where he's going to give us a comprehensive lesson in options theory. He's also going to make some special announcements about CQG, so you're going to want to stay tuned to the end of the episode to catch that interview. Alright, so like I said earlier in the video, today we're going to be introducing the concept of the options Greeks and explaining what each of them represent. Now, the options Greeks in general are different risk factors that affect options. And there are many different kinds of options Greeks, but today we're going to be going over the 5 basic ones: delta, gamma, theta, vega, and rho. The first risk factor that we're going to focus on is delta, and delta is essentially the sensitivity of options prices to changes in the underlying price. So if you think of the options price as its premium, how does that premium change with the price of the underlying asset, like a stock? Long calls have a positive delta from 0 to 1. This essentially means that a long call option with a delta of 0.5 will increase in value by 50 cents for every $1 increase in the underlying asset price. Conversely, long put options have a negative delta from -1 to 0. This is essentially very similar to the delta of the long call option, but it shows you how put option premiums decrease in price as the underlying asset price rises. So a good example of this is if we have a long put option with a delta of -0.5, for every $1 increase in the underlying price, the put option premium will decrease by 50 cents. One of the most important things to note about an options delta is that it's not constant. And throughout the life of an option, that delta value will change many different times, especially as the underlying price changes. Because delta values are constantly changing, it introduces a new risk factor, which is the change in delta. And this change in delta is measured with respect to changes in the underlying price and denoted by the Greek letter gamma. Like I said, gamma measures how delta changes as the underlying price changes. This essentially means that gamma is telling you what is your change of delta for every dollar change in the underlying asset price, whether that be a stock or a commodity future or a bond. At-the-money options have the highest gamma as their deltas are the most sensitive to changes in the underlying price. Okay, so the next risk factor that we're going to discuss is called theta. And theta is often referred to as time decay because it represents how an option loses value as it gets closer to expiration. Theta is often, but not always, expressed as a negative value because all else being equal, options are a decaying asset, which essentially means that options lose value, which is reflected in the premium, as they near expiration, all other factors being the same. Theta can be quoted in many different time intervals, but it's often expressed as a daily rate. The next risk factor that we will discuss is going to be volatility, which is represented by the Greek letter vega. Vega shows the rate of change of an option's price based on a change in that option's volatility. Now, generally, higher volatility causes greater price swings in the underlying asset, which increases the probability that the option will expire in the money by expiration. This essentially means that higher volatility will increase the value of both call and put options, which is going to be reflected in those options premiums. Vega is often quoted as the change in an option's price per % increase in volatility, all other factors being equal. The last risk factor that we're going to talk about today is the effect of interest rates on option prices, which is represented by the Greek letter rho. Now, rho is often expressed as the change in option prices per change in the domestic risk-free interest rate. In the United States, that domestic risk-free interest rate is often represented by the rate of US Treasuries. Okay, so my next guest today is Kevin Darby, the VP of Execution Technology at CQG and the co-founder of Optio Research. Kevin is very experienced in the derivatives industry and has a lot to share with us, including diving deeper into the 5 risk factors that we talked about today and much more. All right, That's going to be it from me for today. Please enjoy the rest of my interview with Kevin Darby. All right, everybody, welcome to another Options Discovery interview. We're back here again for another episode with Kevin Darby from CQG. So Kevin, can you please introduce yourself real quick and just give us a quick summary of your education and career background?
Yeah, sure. Thanks. I'm Kevin Darby. I am Vice President of Execution Technologies at CQG. I also sort of chime in anytime there's anything options or trading algorithm related, and have been in the option space a really long time. Actually, I went to University of Illinois. I was a computer engineering major. However, I kind of got the job before I got the degree. So I left college when I was 19 to move to North Carolina to basically learn how to be an engineer and a quant for an options market making firm. And I spent, that was from 1999 to say 2011. After that, I spun out with a couple of partners, my own software company. And then a couple, 2.5 years ago, CQG actually purchased the assets of that software company. It was an algorithmic trading platform, and I came along with it. And I have been happily at CQG ever since.
So that's really interesting. And so, as the Vice President of Execution Technology, what are kind of your roles or what kind of work do you do at CQG?
Sure. So I built basically an algorithmic trading sort of platform within CQG. So part of the technology that I came with had like a low latency spreading engine with it. And then over the last couple of years, myself and the team at CQG has added execution algorithms like VWAP, TWAP, arrival price, and one maybe we'll talk about a little later, like a volatility algo, so you can trade options and volatility. So I spent about 80% of my time writing code, C++ and C Sharp. And then the other 20 is, helping the team out and or maybe try to contribute to some of the other projects in CQG, like if I feel like it could be helpful.
Another thing that we're going to get into is talking about options as contingent claims, and this is something that you had mentioned in the outline that we had worked on. So, can you talk about this and some of the theory behind options as well?
Sure. So, contingent claim means that you might have a claim to something in the future if a specific thing happened, and basically the idea of options had been around for kind of a while, but really the seminal valuation or point of valuation was the 1973 paper, The Pricing of Options and Corporate Liabilities by Fisher Black and Myron Scholes. And what they did was they said, okay, there's this thing, it's an option, it's worth something if a certain set of circumstances happen. So they really boiled it down to the math. And what they assumed was they made this little universe where the underlying, or the return of the underlying to be more exact, varies sort of in this concept called geometric Brownian motion. This is just basically to say that this thing varies according to a normal distribution. The log of this thing varies according to a normal distribution. And then they essentially created a differential equation that if you made these set of assumptions, then you have this differential equation, and that this is how this thing must act, or how it must move. And then they solved the differential equation with a very important sort of caveat that volatility during the time of the option is constant the whole time, which in real life is not true, but it's one of the assumptions that they made. And then the basic sort of elements of the solution to this equation is basically the probability that the asset for the call would go equal to or greater than your strike price. And then given that, here's the conditional part, that if that happened, the expected price of the asset, given that it is above the strike price. And so that's kind of a weird thing to conceptualize, but it's really important when you think about a contingent claim. So you have two things. You have, okay, what's the probability that my call is going to end up in the money? And then the second thing is, what is the expected value of the asset if that other first thing happened? And when you do that, when you kind of think about it like that, you realize the Black-Scholes equation is both simple and brilliant. And most simple things are brilliant. Most brilliant things are maybe simple. So the idea here with a contingent claim is when stuff happens, the present value of the thing moves around. And then that creates, risks and benefits. And then, we can talk about that in a second.
Yeah. And I think it's interesting because Black-Scholes is definitely something you hear a lot when you're talking about options pricing. Can you talk a little bit about that as well?
Yeah, sure. Do you want me to go through the math, or did you just kind of talk about what the model is essentially doing?
Yeah, just more conceptually what the model is essentially doing. Yeah.
Yeah, so really it's those two things. It looks at this return distribution. So Black-Scholes looked at, it's not the price of the thing that is normally distributed. A long time ago in 1900, Bachelier essentially created a model that said the price of this thing is normally distributed, and that gave rise to a class of option models. Black-Scholes said that the return, or the log of, essentially, today over yesterday, is normally distributed. And once you do that, you can compute basically the probability that the thing ends up through a strike price on the upside. And then you can also then kind of use some tricks to figure out the thing, if it is above the strike price, that that this is its expected value. And really, the thing you have, the thing that lets you do that is this concept of volatility. So volatility is the primary unknown in the Black-Scholes equation. I mean, the factors you have underlying price, you have, contract specific things like strike price, and you have, expiration, whether or not they're dividends or not, and interest rate, which are all kind of like a known thing. But then you have this thing called volatility. And I like to think about volatility in terms of like gambling. So if I'm rolling a dice, a six-sided cube, and gambling on the outcome of the cube, I have a certain set of conditions that could obtain. So that's maybe a low volatility environment. A high volatility environment means that your die is a dodecahedron or a 12-sided cube. And so more stuff, more outcomes could happen at the end of the line. And so higher volatility means more price variance or more expected move during the time of the option. And that makes higher option values, and less makes less. So volatility is really the thing that you're trading when you're trading an option. It's really the thing you're thinking about when you're valuing an option. It's really the thing that options market makers, or people that provide liquidity in options, are thinking in. They're not really thinking in terms of price. They're thinking in terms of vol.
Yeah, that's a really good point, and I think it's definitely something that we've had discussed on the show before. But I really like how you kind of describe that with the gambling argument, because it is a lot about how much variation in price you have, how many different outcomes. I think that's a really good connection there. So the next thing that we have to go over is talking about the Greeks. So this is something that is very important when understanding options and trading options. So can you talk about each of the Greeks and give a little bit of information about each one of them and some of the formulas that are associated with each term?
Sure. So, okay, think of it like this. When an option is sold, the seller of the option actually creates the option. It's not like there's a huge pile of options over here, and like you could go get them and then sell them. No, you're actually making this thing because you're making an agreement with your counterparty, even if you don't know who they are. So the primary sort of cost in the creation or replication of the option happens to be delta. And that was a big sort of invention of Black and Scholes, is they showed that, in a constant volatility environment under a certain set of circumstances, that an options payoff could be essentially replicated by, trading underlying stock and bonds. And so that underlying stock, the ratio of, if you have a $1 move in the underlying, basically the delta is how many dollars that option moves. So usually it's from 0 to 100. And if I have a 50 delta call, the underlying moves up $1. The call is going to move up probably 50 cents, very close to it. So that's delta. It's the first derivative of the value of the option with respect to underlying. Its cousin, its tricky cousin, is called gamma. They're mostly Greek letters, the big ones, but we kind of ran out of Greek letters and made a whole bunch more. So next is gamma, and that's how much delta changes due to a change in the underlying. So it's the derivative of delta with respect to the underlying, or the second derivative of value with respect to underlying. And the reason gamma is there is you have to understand that the options themselves have convex payoffs. So from now till expiration, you're essentially agreeing to a convex payoff, because of the Black-Scholes world. So delta first, gamma second, and then I like to talk about theta after gamma, because if I buy an option, I am essentially buying gamma. I'm buying optionality. I have the rights to do some stuff. And if the thing moves around, I can probably make money. So if I'm buying an option, I'm buying gamma, and I like to have gamma, be long gamma, but I'm also short theta. So every day or every millisecond that I'm long an option, that value that I paid initially is sort of eroding. And if the option doesn't end up in the money, it's going to go to zero. And so the measure of that is called theta, and it's the first derivative of value with respect to time. And there's, there's different quoting things. Some people quote it in years, but I always like to quote it in days. Another one is Rho. And Rho used to be kind of a boring guy, but lately Rho's been a whole thing. So you have interest rate exposure because of that replication argument of Black-Scholes with a portfolio of stock and a portfolio of bonds. So, you have, during the tenor of your option, if interest rates move around, rapidly, you will see P&L events, and that's Rho. And if you wanted to hedge Rho, you'd probably do it in the interest rate derivative market, and that's, a whole other thing about how you would do that. And then finally, Vega is not a real Greek letter. Some people use kappa. We always use Vega. And it's basically the first derivative of price with respect to a 1 percentage point change in volatility, or 100 basis point change in volatility. And this is really, when you're looking at like what I would call a risk report, it's one of these things that, is kind of the real risk you're taking with options. So you can make a lot of these other risks go away, but it's hard to make Vega go away. So what you do, if you're trading a big options book, is make sure that you didn't have too much Vega in a particular spot. But very simply, if you were long, some calls, the calls had Vega. At the money options have more Vega than tail options. And if volatility went up, implied volatility went up, the value of your options would go up. And then there's other weird ones. There's Charm, which is D delta D time, and there's Color, and there's Vanna and Volga, and there's a ton of them because calculus is fun and we like doing derivatives. But those are the main ones, and those are the main risks that you take when you enter into an options contract.
Yeah, wow, that's a great explanation of it. And so kind of moving on to the next topic, because I think that was really great. So let's talk about a little bit about CQG. So you had some things that you wanted to share from CQG in particular. So can you speak about what's going on and some of the new goals or releases that are on the horizon?
Sure. So, our job at CQG is to be on the forefront of, fintech. It's what we all like doing. We've been doing it for 40 years. And, I've been doing it there for about 2.5, and I hope to be doing it for many, many more years. So I think from an algo perspective, options are very cool. So we, coming soon, there's in my algo platform, we have a volatility algo coming out. And so it would allow a user to say, okay, I want to buy the E-mini 4000 call at a volatility level of 30%. And so what the algo would do is essentially take that 30%, run through this Black-Scholes that we just talked about, and essentially price the option based on the future, and allow the user to also then make the futures trade to do the option in a delta neutral fashion. That's coming out. We have a little extension there that's going to hit into the CME spread book as well, because if you can do an option, you can do an option for less edge if sort of the delta is covered for you as a market maker. So sometimes as a consumer, we can get our customers better pricing on options if we do them in the spread book. And the whole thing for the algo stack at CQG is basically we want to facilitate the natural consumer of the contract. So there are funds and there are people who have covered, want covered calls. These people want options, and they just basically want to pay a fair price for it. So I usually think of things like a market maker, but for these algorithms, I tend to reverse it and think like a customer and try to reduce the market maker's edge as much as I can.
All right, so can you tell us a little bit more about some of the blockchain developments? I know we mentioned this a little bit earlier in the interview, but some of the new cool blockchain technology developments that are coming to CQG.
Yeah, sure. So as we saw in the recent press release, CQG has entered into a joint strategic investment with a company called Nuts Finance. And the two companies are essentially creating a blockchain research lab whose first product is yet to be announced. But myself and my colleague Ben Sung are running the joint strategic initiative from the CQG side, along with our colleagues Terry Lam and Daniel Tang on the Nuts Finance side. And basically what we're doing there is we are developing a set of technologies that through blockchain and DeFi sort of bridge the traditional finance, through which we have been a part of, since forever, and then the decentralized or the Web3 type finance that Daniel and Terry helped create. They've been doing this since 2018. So what we did from the CQG side was I built a volatility based matching engine for options, And so it will allow options market makers to make markets in terms of volatility. So they don't have to do that last part where they convert it to price and send it to the exchange. They can basically send their vols to us, and then we can then turn that into price for them when customer orders come in. And we're going to do this in the blockchain space with the Optio research lab that I just mentioned, and we're going to do this in the OTC space for some popular options products as well, because it's a long sort of market maker belief that really what you're trading is the volatility, so why trade it in any other way? So we've developed this technology at CQG and together with Nuts Finance, and it's got some cool benefits. Market makers can transact in vols, and if you think about it, a blockchain-based smart contract that is an option. There's no counterparty risk. If everything's fully collateralized and you and I trade an option on the Optio platform, you got a smart contract and I've got a smart contract, and it doesn't matter what happens. You're at the end of the settlement period, you'll get paid what you're supposed to get paid, and I'll get paid what I'm supposed to get paid, based all on decentralized, trustless settlement mechanisms that happen on the blockchain. So that's my pitch for Optio.
Oh no, that's really awesome. I think I would have never thought of bringing that smart contract blockchain element into it, so you can automatically convert the vol to price, so market makers can just think in terms that they've already been thinking in and not really have to do that last extra step. That's extremely interesting. I think that it really brings a whole new level of flexibility, especially to market makers when they're trading. So it seems like it's going to be a big thing when it comes out. Is there an official release date for the platform itself, or is it just the press release is going to be, or the press release has already been out? But
yeah, press release is out. We'll have another series of press releases. We've been very closely involved with the Starknet people, and that's the L2 rollup that the technology is based on. So you'll see some stuff from us, jointly, here in the next couple of weeks.
That's going to be it for today's interview. Really appreciate you taking the time to speak to us today, and I think the viewers will definitely be happy. I think we covered a lot of information today, so it's great. But yeah, everyone that's watching this now, if you're watching the full interview, you can also stay tuned for the episode as well, where we'll have a little bit of an introduction and a little bit of a shorter interview. And if you're watching through to the full interview, we also have it available now as a podcast. So be sure to check out the podcast on johnlothiannews.com. Is there anything that you want to plug real quick before we close this out, Kevin?
No, I'd just like to say thanks, and we appreciate the opportunity to do this, and look for our CQG and Optio news in the coming months.
All right, well, I appreciate it, Kevin, and I will hopefully talk to you later. Thank you.
Cool. Thanks, Alex. Bye.
All right, that's going to be it for today's episode. I hope you got some value from it and learned a little bit more about the options Greeks, what they represent, and what they mean to options traders. I want to say thank you to Kevin Darby for coming on for this episode, and I will see you all in the next one. Bye. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.